Hey everyone, welcome back to Corporate Decoder. Today we're diving into Vince Holding Corp's latest 10Q filing, quarterly checkup on how the company's doing. Are they stitching together a success story, or are there some loose threads we need to unravel? Stick around to find out, and you might even learn how venture capitalists are making moves in luxury apparel. Before we jump in, if you're into getting the real story behind corporate reports, give us a subscribe. Also, join our Discord community where sharp investment eyes meet and discuss in the description below. This Form 10Q is basically Vince Holding Corp's quarterly report to the Securities and Exchange Commission, or SEC. It tells investors how the company performed financially over the past 3 months. It includes details about sales, expenses, profits, and any major events that could impact the business. This report covers the 3-month period that ended May 3, 2025. It gives us a snapshot of Vince's financial health as of that date. Keep in mind that Vince Holding Corp is considered a smaller reporting company by the SEC. This means they have less stringent reporting requirements compared to larger corporations, so there are limits to what we can see. The company's stock trades on the New York Stock Exchange under the ticker symbol VENC. As of May 30, 2025, they had around 12.8 million shares of common stock outstanding. This is important for calculating things like earnings per share. Now let's look at the numbers. First, we'll check the balance sheets. I'll show you the most important rows. They had about $2.6 million in cash and cash equivalents on hand. Their accounts receivable, or money owed to them by customers, totaled around $23 million. They're sitting on about $62 million worth of inventory. Adding all the current assets gives a roughly $95 million. Their current debts, accounts payable, were ruffled $27 million owed to their suppliers for goods and services. Accrued employee salaries and benefits totaled about $9.3 million. Lease obligations due within the next year amounted to about $14.6 million. Adding up these short-term debts, the total current liabilities were about nearly $61 million. The company's long-term debt sits at around $34.7 million. The company has an accumulated deficit of around $1.1 billion. This is bad. Let's move to the income statement. Tail net sales came in at roughly $57.9 million. The cost of products sold was nearly $28.8 million. Selling, general and administrative expenses, or SG&A, reached about $33.6 million. These are the day-to-day costs of running the business. This resulted in a loss from operations of nearly $4.4 million. This means the company's core business operations weren't profitable. The final result was a net loss of nearly $4.8 million, or 37 cents per share. This calculation is important for understanding profitability on a per-share basis, which is what investors focus on. The 3 months ended May 3, 2025, net cash used in operating activities, over $11 million of cash burn. That's a hefty price to pay for operations compared to the same periods. It points to a worrying trend of declining operational efficiency. The report highlights borrowing trends for the last 3 months. There were roughly 63.15 in proceeds from borrowing under the revolving credit facilities, with total financing activities providing a net cash of Wrigley $15 million, net cash of Wrigley $15 million. The company has operating leases. Here its assets are broken out. Vince Wholesale sits at about $70 million, and Vince Direct to Consumer is a higher number at $95 million. There were changes in the limitations of restricted payments. There were amendments added in January 2025 under the credit agreement where they wouldn't be able to make such payments. But these limitations may be reduced following some requirements. The document highlights more board seats or management opportunities may be assigned to some parties of the transaction. During the 3 months ended, the company recognized roughly $140K for share-based compensation. Let's discuss recent transactions. On January 22, 2025, P180 Vince Acquisition Co. bought a majority stake in the company at roughly $20 million. At the same time that P180 acquired around $7 million, forgiving that entire loan. That means that Sun Cardinal also designate its own board of directors per the regulations. And it means it's no longer a controlled company. Looking at how much cash it has and where he is going to spend it for a little bit for the description, it can see that they're having some problem, but is still optimistic on how to turn around their problems. So what's the takeaway here? Vince Holding Corp. is at a crossroads. The P180 acquisition could bring fresh ideas and capital, but the company needs to show it can turn things around quickly. The declining sales and continued losses are major red flags. The P180 needs to streamline operations and boost those direct-to-consumer sales. They need to focus on turning the core Vince brand momentum into actual profit. The main risk is their level of debt versus their assets, and if they're unable to do so, this may lead to material losses of this firm. Also, there's ABG Vince that it partially depends on and how sales are licensed out. Vince shows an overall weakness. This company is dependent more on brand strength and good strategy to actually show profits and strength. For now, I'll take a pass on this investment. Alright, that's our breakdown of Vince's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.